So let's start with the introduction. Hedge instrument in financial market, as we mentioned earlier. And today, what we are trying to say by employing the hedging. Hedging is a risk management strategy that involves offsetting potential losses by taking an opposite position in a related asset. So let's say this one. First of all, until today, lots of different classes. We speak about the commodity market, we speak about the stock exchange market or fixed income market. And generally, when we speak about all those topics and when we go into details, we generally speak about the spot market. Spot market is this. You are buying or selling something, and at the end of the session, 1 day or 2 days later, you will get your cash or you will get your stock. For instance, Dr. Walchin now making a trading in S&P 500 and he holds Tesla stocks and I have cash. I want to try to buy a Tesla stock and I'm giving an order for Tesla stock. And at that same price, Dr. Walchin giving an order to sell, and our buy and sell order matching, and Dr. Walchin selling the stocks and I'm buying the stocks. But Dr. Walchin cannot use the cash at a specific time of period. This is the matching. What can I say? Because Dr. Walchin sell the Tesla stock, now I hold Tesla stock. But the cash, the Dr. Walchin will get at the end of the period of session, T+1 or T+2. And this is the spot market. Okay, I'm buying spot market or selling the spot market, equities, stock exchange, fixed income, or commodities. But if I'm speaking about the derivative market, it is a little bit different. Please look at, first of all, the definition here. Hedging is a risk management strategy that involves offsetting potential losses by taking an opposite position in a related asset. And where I can make an hedging strategy, even in commodities, securities like the stock exchange, or currencies like the euro, Australian dollar, Canadian dollar, or interest rate swap, I can take a hedging position in interest rate market as well, even in the weather condition. So this is like a bet. Okay, ladies and gentlemen, the hedge is like a bet game. And generally, please look at this side. This side is trying to make a definition of the hedging types: forward, future, and money market. A few minutes ago, I tried to explain you the spot market. Spot market is like a cash. I'm giving the cash and I'm buying the stock. Or I'm giving the cash and I'm buying the treasury bond or government bills. Okay, this is the cash market, spot market. But if we speak about the derivative market, this is a little bit different. Derivative is something like this. In the future, if Ismail and Dr. Walchin expected that cotton, cacao, or soybean, or petroleum, any type of commodity, agriculture, metal, what can I say, energy, or any type of money market instrument like interest rate. If you think that 6 months later, let's say Ismail has a factory owner, okay, in their country, he has a factory owner, and he is importing the cotton from United States. Regularly, every week, Ismail is imported cotton or soybean from the United States. Let's say $1 million. But Ismail, from the market sentiment, expected that 6 months later, cotton price will rise approximately 80%. Okay, he expecting that cotton price 6 months later will increase. Today, Ismail should take an action. Why? Because if the price is going up, I should fix those prices for myself to reduce my losses, right? If, let's say, if my clients come today to the Ismail factory and if they say that 6 months later, we need a output from your factory that is using the cotton as input and producing bad, let's say bad, okay, for the furniture. And they are giving the price today, and they are supposing that 6 months later prices will be almost same. But Ismail know that the input, the cotton price, okay, the raw material will increase 80% 6 months later. So to satisfy the client recommendation and their order, Ismail should fix the cotton market prices for themselves, for their factory. And he's taking a hedging position, forward or future position in cotton market in the United States. Why? Because if the cotton prices go up 80% after 6 months, and if Ismail sell the furniture today with the same price, Ismail will lose 80% from this trading, right? So this hedging is to minimize your losses because of the volatility in the financial market. Okay, because of the, for instance, let's say there is a drought, there is a bad weather condition in the United States or South Africa, and you know that there is a drought in the market, and nobody will grow any bread in the market, wheat, okay, wheat market. There is no grain in the wheat market. There is no grain in the soil. So if there is no satisfactory supply in the wheat and the grain market, then you know that the supply will decrease and prices will go up. So to minimize your losses in this type of volatility, to minimize your losses in weather condition, financial situation, geopolitical crisis. For instance, when Iran attacked Israel, oil prices go up in one day approximately 20%. And you are, let's say you have a factory or you are using a petroleum stock, and if you import petrol yesterday for $1 million, you will get approximately $1,000, 1,100 barrels. But with 1 million, now you will get less, right? Because of the attack, increase the prices, you will get less. And if you see that there is a problem in geopolitical crisis, you expect that this will increase the oil prices in financial market. So yesterday, you are taking a fixing forward or future contract in the financial market to reduce your losses. So basically, the spot market is buying and selling in cash for some prices, but the derivative market making for some future probability for your gain or losses in any type of condition to minimize your losses in financial market and to make your profit in a stable condition. Now, please take a look at this chart, first of all, for 10, 15 seconds. This chart is showing the hedging cost and the yields. What does it mean? Cost of hedging the United States dollar investment. This is the annualized cost in the y-axis. And please take a look at here. This light blue showing for a Great British Pound investor. The black one is for Australian dollar investor. The purple one for a euro investor, and green one for a Japanese yen investor. And what is the cost of hedging for the United States dollar? As you see, at the end of the COVID-19 crisis, when the inflation is hiking up, Japanese yen cost of hedging in the United States dollar in terms of Japanese yen is approximately 6%. Why? Because United States Japanese yen currency is depreciating, right? When the inflation is going up, In the Japan economy, everybody in the financial market expected from the Bank of Japan to increase the interest rate to fight with the inflation. So the cost of interest payments according to in terms of Japanese yen is increasing for this case. So the hedging for the United States dollar in terms of Japanese yen is rising. But it is stable around 2 or 3% for Great British Pound, Australian dollar, or Euro, the European currency. But when we go to the 2010, what is the Australian dollar investor to hedge a United States dollar investment? It is minus. This is meaning that if you take a position in the United States dollar to hedge your any stock, derivative market, or money market instrument, in terms of Australian dollar, if you are buying or selling in terms of Australian dollar, your hedging cost even being money to you because it is minus, right? You will not put any additional cost for your hedging. It will additionally being the profit for you because United States dollar is really cheap at the 2010 because of the global financial crisis. Please remember the helicopter money and the Ben Bernanke. They distribute billion dollar each month. And the cost of United States dollar is really cheap at those times. For that reason, if you're buying anything in the Australian dollar, and if your cost in terms of United States dollar, it will be minus. Even for this position, you will get additional money. And on the right-hand side, please take a look at the title of the chart. It is hedged and unhedged 10-year government bond yields. This is hedging for Australian dollar-based investors. This is black bar showing the local yield. The dark blue is showing the hedging adjustment. And the light blue with rectangle showing the hedge yield. And here, as you see, Italy, France, Spain, Japan, Canada, Germany, Australia, United Kingdom, China, and United States here. Except the United States and the UK, if you put a 10-year hedge and unhedged 10-year government bond yields in Australian dollar, for Italy, France, Spain, Japan, Canada, Germany, and Australia, they are at their maximum. Even for the China, it is also maximum. But for the United Kingdom and the United States dollar, meaning Great British Pound and USD, they are not at their highest yield because you are losing money because of the currency appreciation and depreciation. It is about the volatility. And your hedging yield is less than your local yield, right? Because of the hedging adjustment is minus for the United States and the UK. And please take a look at here, bull and bear markets. Just give 30 seconds for you to take a look at for this chart. Here on the left-hand side, you will see the length and severity of bear and subsequent bull market. What it is saying, here, number of months and S&P price return. Here on the x-axis, I have number of months, meaning that 12 months, 1 year, and until here, 120 months, meaning 10 years. And here I have the price return. This is just nominal price return. And here I have different dates for this hedging instrument. 1973, stagflation. Please remember the oil crisis in financial market. And 1980s, Volcker tightening, another crisis. And 1987, the doomsday, the Black Monday, the disaster day at those times. And 2000, the tech bubble, it is the dot-com crisis, internet crisis. 2007 global financial crisis, 2020 is the pandemic crisis, and the 2023 is the inflation spike. And please look at the global financial crisis chart, the light blue one here. This is the subsequent bull market and bear market. In any case, ladies and gentlemen, please look at the technological bubble. For the first 24 months, meaning for the first 2 years, even you can see your price return will be minus around 50%, right? But even technological bubble crisis 2000, if you wait until 5 years, your return will be positive 100. Your price action will be doubled. For instance, if you take a look at for the global financial crisis, for your first 24 months or 12 months will be minus 50%. But if you wait 10 years, it will be around 4 times higher from your prices. Initial prices will quadruple when you make a patience for 10 years. If you wait until 5 years, your price action will be positive 200%. In any case, please look at here. This is the summary of this chart. It is saying that average number of months, bull market and bear market. Bear market meaning you are losing the money, and bull market is you are gaining the money, earning the money. And your earning is approximately 221%, and your losses is just 38%, ladies and gentlemen. So timing and patience is everything in the correct stock, in the correct fixed income, or any type of instrument in financial market. Okay. If you look at the long horizon for your time period, you will get the best gift from the financial return. And here I have global equity performance and the United States dollar. Please take a look at for 10 seconds. Here in this chart, I have the time allocation here for approximately 30 years. And here I have, please look at the definition here, international out or underperformance versus United States MSCI index, excluding the United States, S&P 500, and total return in United States term, and rolling 3 years annualized, meaning that 3 years annualized performance here in S&P 500 in United States dollar, and this is a total return. And please take a look at here. Before the dot-com crisis, we have a shock. And here, as you see, we have a crisis period. And here, international underperformance, the United States, here. And here, international outperformance, the United States. Because when the crisis started in the United States stock market is crashing, and international market is positively differentiating from the United States. But after the global financial crisis, United States stock market in every action fighting the international peers. So to put the position in United States performance, it is better for you in any case. And here we have alternatives. What can we do? Because there are lots of alternative investment in the financial market, and these are showing the correlation, return, and yields for you. And here on the left-hand side, I have 10-year annualized return for my overall investment, because I'm making a basket. In this basket, I can put the real estate investment. I can put lots of infrastructure investment from government bonds. I can put the private market or money market instrument, or I put my money in hedge funds. And here, as you see, this is the trailing 10-year correlation to 60-40 portfolio, 60% stock and 40% fixed income securities. And here, these are the trailing correlation. Here, as you see, the annualized return for instance, the best well-known investment for the private equity, the private equity correlation is approximately 0.8% with the bubble side yield. This the circle showing that how much it is bigger. For instance, if it is small, it is 0%, or if it is mid 3%, or if it is large like this, it is 10%. So this is the 60-40 portfolio allocation, and in directional hedge fund, if you put your position in hedge instrument, its correlation is 1%, meaning that in which way you are taking a position in financial market, if you make the cross action in hedge fund, your correlation at the end of the period, when you take a position and when you evaluate your profit and losses, its correlation will be 1, exactly the same. And now I can distribute my allocation, because if I buying equities, I should make an hedging in the real estate market, for instance, because if there is an increase in the equities, real estate should be a little bit different. Why? Because just think this: if the interest rate is going down, real estate market or the housing market appreciating in the United States or even rest of the world. Why? Because decrease in the interest rate making cheaper the mortgage loan, right? It will be make cheaper your mortgage if the interest rate go down. And if mortgage is cheaper, you will buy more houses. And real estate market or the price of the houses will go up, it will rise. So the real estate, if the interest rate is going down, real estate market benefit from this action. What about the equities market? The equities working like this, ladies and gentlemen. Equities is a risky asset. If the cost of money is the interest rate, is high, lots of people sell their stock and put the money into cash. Why? Because cash return, the interest rate will be better. So if interest rate goes down, vice versa, I will take my money from cash market, money market, because interest rate going down, and I will get less interest rate return. So I will put my money to the stock exchange. So if interest rate go down, stock market or equities benefit from this action positively. So real estate go up, equities go up. What can I understand? Real estate market and equities market are positively correlated, right? They are positively correlated. If equity is going up, real estate market is going up as well. But this correlation, this cyclicality can be negatively differentiated in recession period, like here, or like here. Okay. So sometimes even the real estate prices is stable or fixed, equities get excess sell-off action because of the crisis in the financial market. And this positive correlation cyclicality can be break down in some crisis period, like the COVID-19 crisis, like the global financial crisis, or like the dot-com crisis in the United States. And direct real estate correlation to the S&P 500, this is 12 quarter rolling, meaning yearly total return from the 1980s till now, approximately 45 years. And here, as you see, in the crisis period, the fluctuation, as you see, the fluctuation between minus 0.8 and around 1. And the fluctuation generally clustered around the positive side, here as you see. And please take a look at this chart as well. This is the alternatives and manager selection for any type of hedging instrument. If I put the public and private manager dispersion, here, please take a look at the definition and what we mean by this bar. This bar is showing the 75 percentile and 25 percentile, and the orange rectangle showing the median during this period. And this explanation is global large capital equities, global bond, US core real estate, global private credit market, United States non-core real estate and global private equity, global venture capital and hedge fund. Please look at here the hedge fund side, because today topics is showing how the hedge funds making money by taking opposite position in financial market. As you see, the hedge fund losses is just minus 0.2, but their return, positive return, is around 14%, and their median is just 5 and 7. So if you put your money, let's say in US non-core real estate, it will bring a loss for minus 4%, or in global venture capital, it will bring again a minus 4%. Or if you take another volatile position in global private equity, it will bring 21%, but it is really volatile for your position because your position are non-hedged. And here, as you see, the 14% bring almost with non-zero profit. There is almost no losses in this hedge funds. And here I have time diversification and volatility of the return. This chart is really good because stock, bond, and 60-40 portfolio allocation. And this is annual average total return for 20 years. And if you put your money into just stock, it is 11%, but it is risky. If you put your money in the bond market, less risky. And if you make a basket, and if you make your minimization of the losses in the financial market with 60-40 portfolio allocation, your annual return will be around 9.4%. And if you put $100,000 for 20 years, it will be around 600,000 for the 20 years. And this is a really good money. But if you put your money in the stock market without making any allocation, it will be around 900,000. But you will lose lots of money during these 20 years. And the risk investing and the power of the compounding. Please take a look at this chart for 10 seconds. I should make an explanation here, the power of compounding. Here again, we have power of compounding as well. If you wait with patience your money at the end of the 20 years for just $100,000. And here, again, the power of compounding, change in purchasing power by investment in major asset classes, growth of just $10,000, adjusted for inflation. This is real return, ladies and gentlemen. There is no price effect in it. This is real return from 1995 till 2024 annual return. And your $10,000 in large and small cap will be around $80,000, 8 times higher from your initial investment. But if you put your money with less risky asset like cash and corporate bonds, it is just around $10,000. Even in cash, and if you make your inflation adjustment, you are losing money. At the beginning of the 1990s, you have $10,000, and at the end of the 40 years, you have just 9,100. Meaning that because of the inflation in cash, you are losing $900 by waiting 20-30 years. Do you understand what we mean by take risk, wait with patience, and in the correct address? Okay, not wait in the wrong station. Okay, if you wait in the correct station, your money will be around $80,000. But if you put your money only just in your bank account, it will be lose the value, purchasing power will be less because of the inflation effect. And here I have cash versus a 60-40 portfolio distribution. Percentage of time 60-40 returns were positive or outperformed cash. And here, please look at this one. The stock outperformed cash, and percentage of time 60% performance was positive. Please look at this one. In any case, ladies and gentlemen, in any case, 1 month, 6 months, 1 year, 3 year, 5 year, 10 year, and 15 year, the percentage of the 60-40 outperform the cash, especially in long term, all of them. For 5 years, 10 years, and 15 years, almost 100% of the allocation is outperforming the cash. But for instance, let's say for the short term, just 1 month, 68% is outperforming, meaning that 33% is underperforming the cash. But if you wait patiently in the longer term, in any basket, you will get higher than the cash. And this is another manager dispersion for the 20-year return dispersion for growth of the capital. Here, please look at the definition. Large capital blend, mid capital blend, small capital blend, large growth, large value. By the way, please remember what we mean by value and growth. If you are in a stock market and if you are in a venture capital like a new company, it is a growth company. But if you are like Nvidia or Microsoft, it is a value company. Okay, the growth and value can be differentiated from this definition. Emerging market equities, ultra short bond, short-term bond, intermediate core bond, multi-sector bond, and high yield. Please look at the highest performance, large growth. Why? Because they are volatile. Okay, if you don't hedge your investment in large growth investment, you will get higher money, but at the end of the session, you can even lose huge money in your investment value. Please look at the definition here as well. This is the growth of $1,000 invested with top decile manager, and this light green one is growth of the $1,000 investment with the bottom decile manager. In any case, if you are in the volatile side, you will get higher money. If you are in the short-term bond, the term is really short and it is bond, no volatility, and you will get the least money. Okay. And this is the last slide from my perspective today. This is 60-40 return and stock bond correlation. Please look at the definition here. I have here the total return in percentage, and I have here the time frame from 2000 till now, 25 years. And light green bar showing the equity return. The dark one, the black one, is fixed income return, and the allocation for 60-40 calendar year return. In any case, please take a look at this one. The portfolio allocation, especially in, for instance, here in the crisis period, minus, COVID-19 minus, dot-com crisis minus. But if you want to get the highest return, you can put your money here in the equity return. Okay, for instance, the equity return is higher here than the 60-40 portfolio allocation. But if you take the average of this bar, the best case for this, not put all of your money in equity, not put your all of money in fixed income, just make a basket with 60-40 portfolio and hedge your instrument, because equity is risky, and if you lose money in equity investment, you will hedge those losses with fixed income positive return. And this is the S&P 500 and US 10-year Treasury correlation. And here, as you see, normally until the 2000, the millennium years, the general correlation is positive. After the dot-com crisis, till the COVID-19 crisis, we have a negative correlation.